Warren Buffett is known as a value investor. And in this episode of the Wealth Nation podcast, we're going to look into value investing, what it is, and how to become one.
Welcome to the Wealth Nation podcast, a podcast for every mother, daughter, grandmother, sister, and wife, and the men who are smart enough to tune in. The Wealth Nation podcast brings you all you need to know about investments, business, property investments, personal finance, and all-around financial wellness. Here is your host, Yolanda Rose.
Thanks for joining me today in another episode of the Wealth Nation podcast. I am Yolanda Rose. I'm a financial advisor. I'm a wealth coach. And it is my goal on this podcast to give you easy, actionable tips, content, and strategies that you can use to manage your money well and to build generational wealth. So if you're new here, please subscribe to the podcast. Whatever platform you're listening on, just hit that subscribe button. Also, link up with us on our various social media platforms. It's Financially Fabulous Females on all the major platforms. The Wealth Nation podcast is sponsored by Financial Success Summit 2021. Now, this is a conference that I am putting together. I am getting the top folks in their industry, from a property to Bitcoin to formal investments, banking, short-term insurance, budgeting, all of the tools, all of the tips, all of the tricks, all of the strategies that you need to break free financially. I'm getting all these folks together in one virtual room that's happening on the 17th and 18th of April 2021. So if you want to get tickets to this event, go to the website. It's www.financialsuccesssummit.net. and buy those tickets. Tickets are selling for just 99 Rand. And if you use this coupon code for a limited time, you can get early bird tickets. So go and shop for tickets. You're going to get a 60% discount and pay just 40 Rand for 2 days of power-packed financial advice. Use coupon code early bird at checkout. This offer expires on the 31st of January 2021. So we're talking about value investing today. Now, what is this? What is this term value investing? So here's the thing. Value investing basically focuses on buying undervalued shares of strong companies and holding them over a long period of time. So this is going to be the first in our mini series where we look at the various investment strategies, and we're kicking off with the value investing. So we're going to look at various investment strategies in the coming weeks. Today, we're going to break down value investing. We'll also be looking into another investment strategy called growth investing. We're going to be breaking down momentum investing. We're going to look at the dollar cost averaging investing system as well. As an investor, you got to kind of identify what kind of strategy you're going to use. You're not going to guess, right? I'm going to invest in ETFs or unit trusts or even shares, but you need a game plan. And that's what this episode is all about, is letting you know what are the various levels of strategy that are out there. And for our wealth insiders, for the coming weeks or the coming months, we're going to be breaking down these various strategies. I'm going to show you the complete analysis part, give you tons of tools. So if you are not a wealth insider, please join us on our private membership platform. You can go to www.financiallyfabulousfemales.com/join. All right. And that's going to tell you all the details about Wealth Insiders. This is where you can get a whole array of various trainings that we've put together, tons of videos that's available to you to learn about money and finance from a South African perspective. And basically the thing about all investment strategies is that they're flexible. You can choose one way to go, but over time you change, your needs change, your goals change. And if that sort of investment strategy is not suiting you at that point, you can easily swap over to another investment strategy. But before you even start researching various investment strategies that you would like to adopt, it's really important for you to gather some basic information about your very own financial situation. All right, you got to understand what is your current financial situation. Are you in the place to invest? Have you cleared up your debt? Check out our Wealth Nation podcast where I spoke about the 3 things that you need to do before you start investing. So work through those 3 steps. And then when you're ready, come back to this podcast and start looking for an investment strategy for you. All right, so you also have to consider your cost of living, your monthly expenses, what your debt repayments are, and you got to understand how much you can really afford to invest, both initially and on an ongoing basis. So once you clear up your debt, you're going to have a lot more to spend on. And if you really analyze your spending habits, you're going through your credit cards, your bank statements, you'll realize that you have a lot more to spend if you're a little bit more disciplined. And if you're following us on social media, I put out a post this week that none of us really have money problems. What we really have is discipline problems. And if we can get our discipline in terms of our spending and how we handle our money into focus, we're going to have a lot more. We're not going to be chasing money all the time. Money is not going to be worrying us. Bills are not going to be a thing that occupy a space in our mind. All right, so we got to get our discipline in control. And if you're a wealth insider, also if you are one of our course buyers for the kids course, we spoke about delayed gratification. Go into those teachings, print out those documents, and try and implement them in your home. You know, the thing about making these financial changes, it's not something that happens overnight. It's these small changes that you build a pattern on. You establish these small behaviors, and in a year's time, in 2 years' time, you'll see that you're light years ahead of where you were just a couple of years ago. So you need to set out your goals. Everyone has different needs, all right? So you should look to determine what are your needs. Are you intending to save for retirement? Are you looking to make a big purchase like a home or a car in the near future? Are you saving for your children's education? So all of these things will basically help you narrow down your strategy, because if your kids are going to school in a couple of years' time, you know what strategy you're going to take. You're not going to be very aggressive. And you're not going to look for something that is going to take a long-term investment horizon for you to see any results.
Raising financially savvy children involves teaching them a variety of skills, from budgeting to planning to earning and saving. Besides giving them an understanding of the value of a rand, it prepares them for real-world finances. Financial literacy is a vital skill, and it is never too early to teach your kids about money. Many parents wonder how they can teach their kids about money and where to find age-appropriate resources. You can now purchase the Financial Literacy for Kids workbook, which is aimed at primary school kids. It's now available at www.financiallyfabulousfemales.com. This workbook provides you with 12 lessons, activities, lesson plans, discussion points, and quizzes that you can use to test your kids' knowledge. Shop now at www.financiallyfabulousfemales.com.
Like what you hear so far? Make sure you never miss a show by subscribing on Apple Podcasts, Spotify, or Tuned In. Now back to the show.
Then you got to figure out what your risk tolerance is. Now, if you are my client, we most likely have done this already. And if you are a wealth insider, I want you to check out the investment page and download the risk assessment tool. That's basically going to ask you a bunch of questions that will help you to analyze your level of risk. Are you an aggressive investor? Are you a moderate investor? Are you a conservative investor? So you got to know, can you stomach losses? You got to know the type of investor you are. This is normally determined by various factors, and you'll see in the questionnaire, we're looking at your age, your income level, how long before you retire, how much you have in savings, how much debt you have. Obviously, the younger you are, the more risk that you can afford to take because you have a longer period in the market. However, if you are a little bit older, you're going to have to be more conservative, and you don't want to be too risky when it comes to investing. So once you've established that, you dive headfirst into understanding what is your investment strategy going to be. All right, so the goal of this episode and the next couple of episodes in this investment strategy series is to give you a basic understanding of what you're going to get into with this various investment strategies so that you're not investing blindly. So let's get started with value investing. Now, value investors are bargain shoppers. They seek shares that they believe are undervalued, or even unit trusts, or even ETFs, all of which are undervalued. And they look for share prices that they believe that don't fully reflect the actual value of that asset, a business or a unit trust. So the value investing is predicated in part on the idea that some degree of irrationality exists in the market for this particular asset to be undervalued. So this irrationality in theory presents opportunities to get the shares at a discounted price and make money from it. So it's not necessary for value investors to just sit with tons and tons and tons of financial data to find deals. There are thousands of value unit trusts out there that give investors a chance to own a basket of shares thought to be undervalued. So investors can change strategies at any time. But in doing so, especially a value investor, it can be costly. So despite this, many investors give up on the strategy after a few poor performing years. And we see a lot of that now in South Africa, where stocks are underperforming and people are just bailing on those shares, on those unit trusts, on those ETFs. In 2014, the Wall Street Journal reporter explained that over the decade that ended in December 31st, value funds specializing in large shares returned an average of 6.7% annually. But the typical investor in those funds earned just 5.5% annually. So why did this happen? It's because too many investors decided to pull out their money out of those investments because of poor performance and basically escape those investments. So the lesson here is that in order to make value investing work, you must play the long game. And one person that does this absolutely well is Warren Buffett. Now, we all know Warren Buffett. He is a slow and steady investor making amazing investments over the decades that has landed him to be one of the richest men in the world, together with his investment company, Berkshire Hathaway. If you really are a true value investor, you don't need anyone to convince you to stay in the long run, because this strategy is designed around the idea that one should buy businesses and not really shares. And by this, we mean that the investor must consider the bigger picture, not just the temporary share performance. People often cite Warren Buffett as the optimum value investor. And because he does his homework, sometimes it takes him years to get a move on. But when he's ready, he goes all in on it and he's committed for the long term. You'll see Warren Buffett holding shares for decades, like Coca-Cola. He bought Coca-Cola shares, I think it was in the 70s. And he's still holding those very shares today. In some cases, almost 40, 50 years later, he still has those shares. All right, so when you are doing in value investing, all right, you're doing your research, there are various financial tools and financial analysis that you got to get going. Now, I don't want this to freak you out. All right, this is not a difficult thing to do. And Wealth Insiders, you'll see when we do our training that it's not going to be difficult for you. I'm going to really, really simplify it, give you all the tools that you need to start analyzing shares, analyzing unit trusts and the like, to understand whether the share fits into your financial plan. So one of the ratios or financial statistics that we look at is called the PE ratio. And this is some information that you would get in the fund fact sheet of that particular asset. Now, this has often become a primary tool for identifying undervalued or cheap stocks. And PE basically stands for price earnings ratio. So this single number comes from dividing the share's price by the earnings per share. So the lower the PE ratio signifies you're paying less per rand on the current earnings. And value investors seek companies with a very low PE ratio. So while using this statistic, the PE ratio is a really good start. It's not something that you can look at in silo. You got to look at other things as well. And we find that in this investment strategy, investors are basically lured in by these low PE ratios, which are temporary because of some kind of accounting inflation around dividends times. But these low figures are in many instances the results of falsely high earnings figures. That's the denominator bit of the ratio. Well, the real earnings are reported, not just forecasted. They're often lower. So this results in the reversion to the mean, and the PE ratio goes up, and the value that the investor pursued is actually gone because of some accounting glitches. So if you're using PE ratio alone, it's a very flawed way to look at it. You should, as an investor, find the true value of those shares. So in essence, value investing can work so long as the investor is in it for the long term and is prepared to apply some serious effort and research into the share selection. So those who are willing to put in the work, to stick around and are really, they stand to gain. And we see even Warren Buffett holding shares for decades and decades. That's how he makes his gains. That's how he builds his billions upon billions. So after research, the next thing that we got to do is basically diversify. And we've all heard about the term, do not put all your eggs in one basket when it comes to investing. And if you're my client, we know we always speak about diversification. And when putting portfolios together, we look at a wide range of asset classes to bring about that diversification. So intelligent investors have many different types of investments in their portfolios. So this protects you as an investor from serious losses, and that is why we diversify. Although true value investing has been proven to offer steady annual returns, it is not always guaranteed. And if you follow me for a while, investments are never guaranteed unless your financial advisor tells you this is a guarantee of your investment. This is how much you'll get back. This is how much you're protected. This is how much it's going to cost you for a guarantee. No investment is guaranteed. Number 3, you got to look for safe and steady, not extraordinary returns. Now, this one is usually hard for new investors to grasp because everybody wants to make money really, really quickly. And you'll always find people coming up with content, 5 best shares out there, 5 best unit trusts out there, best performing unit trusts out there, because that's what people are looking for. They want to make money really, really quickly. And I remember reading an article once where the writer was saying if you're reading about a hot share or a hot investment tip, it's basically too late to invest. And it makes sense, yet we still go and buy into the hype and go and buy into those kind of investments. Few of us want to put in the time, the effort to get safe, steady returns. We all want that double-digit returns, and it's not always possible, realistically possible, and safe and legal. So we want those shares that are going to explode in value and give extraordinary returns, and it's not really realistic. You might be able to find shares like that, but it won't be for the long term. It won't last you very long. At some point, that strategy is going to fail. So instead of seeking immediate market-beating returns, as an intelligent investor, you want to be consistent. As an intelligent investor, you will be happy with low-risk, consistent returns on their investments year after year. So look for those kind of shares and those asset classes that meet your personal needs, and try not to beat the portfolios of those who do this for a living, because, there are people that get paid to do this, right? So why do we need to stress? So those are the basics of value investing. And Wealth Insiders, I'm going to see you inside this month's training, the February 2021 training on how you can get started with value investing. We're really going to go in deep, and it's going to be a long session, and we're going to be breaking it up because there's so much to go through, especially the technical analysis. But I don't want you to be intimidated. I'm going to really break it down, make it as easy as possible as I can for you, and do a lot of the work, give you a lot of templates that you can use to get this done. All right, so that's it for me on this episode of the Wealth Nation podcast. Don't forget to get your tickets to Financial Success Summit 2021. All right, you guys have a great week. Be blessed, and check us out on YouTube and the various other social platforms that we're on.
Thanks for tuning in. Make sure to visit our website at www.financiallyfabulousfemales.com and sign up for our free investment masterclass.